Hey there, Chris Rowe again with True Market Insiders. Today I'm going to talk to you about what a PE ratio is, why it's important, how to use it, and you're going to fully understand it as soon as we're done with this. It's going to help you value companies, and I'm not going to get into lots of fundamental analysis on how to value companies, just specific to the PE ratio and why it's important, and why Warren Buffett is looking at this market right now as insane and overbought. Chris Rowe, True Market Insiders. I am money manager for the last 26 years. I am now an advocate for the individual investor. I'm now getting online to the social media platforms and YouTube. So subscribe to my YouTube channel, and you can also subscribe to anything. You can follow me on any social platform at Chris Rowe Trader. Again, the handle is Chris Rowe Trader. Subscribe to my YouTube channel. All right, what is a PE ratio? It's a price to earnings ratio. Price to earnings ratio is a common ratio for valuing a company. And for the sake of today's conversation, just make it nice and easy to determine if a stock price is considered to be overvalued or at fair value or undervalued. We'll also determine if the stock market as a whole seems to be overvalued or undervalued or at fair value right now. Spoiler alert, like I said earlier, when considering the average PE ratio of all S&P 500 stocks, the S&P 500 index seems to be saying the market is way overvalued right now. That is, the price is too high by historical measures. But overvalue doesn't mean over. The bull market might not be done. PE stands for price to earnings ratio. It's telling you how the price of a stock relates to the company's earnings. Very simple. A company that earns $2 a share, trading with a PE of 12, is going to be trading at $24 per share. If a stock is at $24 a share, earns $2, PE is 12. Stock is trading at 24, and that is 12 times earnings of $2. 2 times 12 is the stock price of 24. So we first look at the company's earnings per share and just multiply by some number, the PE, to get the stock's valuation. So that number is the PE ratio. Notice that I said earnings per share and not simply the company's earnings overall. Earnings per share is something that I like to clarify just to make the rest of this much, much easier for you. So if a company earns $12 million, and that company has 1 million shares outstanding or that exist, we would say that the company is earning $12 per share. So I'll repeat that. If a company earns $12 million and that company has 1 million shares that exist, you divide that $12 million in total earnings by that 1 million shares to know how much per share. And we know it's earning 12 million, so that's $12 per share. Or if that same company that we said earns $12 million has 10 million shares outstanding instead of just 1 million, again, the company is still earning that same exact $12 million, same as before, but since you're dividing it by 10 million this time, 10 million shares, instead of 1 million shares, the company is said to be earning $1.20 per share instead of $12 per share. Just move the decimal over. So we can continue and say if it had 100 million shares outstanding, that the company would be earning 12 cents per share, and so on and so forth. It's the same exact company, just divided by different quantities of existing shares. That's called outstanding shares. And it's all the same exact thing. So don't let that part intimidate you or confuse you. If I, as the CEO of my own company, decide that I want to make my same pizza pie of a company and divide it into more slices, then I can do that by signing a few forms, and poof, we have more shares, but it's the same amount of pizza just cut up into more slices, and it'll satisfy fewer people. In the same way that when you slice a company into 10 million shares instead of 1 million shares, you have more shares of the same company, and you're earning $1.20 per share instead of $12 per share. So that's simple enough, right? Using pizza to make it a little easier. Now I'm hungry. Now that's how we determine earnings per share. And when trying to determine the fair valuation of a stock in terms of the PE, we typically speak in terms of 1 share of stock. And so we consider how much the company is earning per share. So again, let's say $1.20 per share is the earnings of our company. Let's call it Chris Co, because I'm Chris. If that company is trading at $12 per share at the moment, then the PE ratio is actually very easy to calculate. It's 10. Chris Co has a PE of 10. What if it's trading at $24 per share? Well, then the PE is going to be 20. It's trading at 20 times earnings per share of $1.20. Simple enough, right? We beat it to death. So let's say it's a biotech research company that suddenly realizes it may have a cure for some major disease, and will have to go in front of an FDA panel to get the drug approved. Well, Chris Co can suddenly trade from its price of $24 up to $120 per share like that just because of that news. Remember, the company is still earning $1.20 per share. So instead of trading at 20 times those earnings when the stock was at $24, the company now has a PE ratio of 100. It's not trading up. It's now trading up at 120. That seems to be a very high PE ratio, but the argument here from the manager of the fund or the analyst or the people that are buying the stock up at 120 with 100 PE and continuing to push the stock higher with their buying is that the company will probably at least 5x its earnings in the future. So let's pause here for a second. The stock was at 24 with the company earning $1.20 and had a PE of 20 times earnings. It's at 24. Now the same company that's still earning that $1.20 per share saw the stock rise to 120. It's trading at 100 times earnings right now. And if analysts told their fund manager that they work for that this biotech company will likely earn $6 per share in the future, then what would that mean to the PE ratio? Company earns $6 now, 5 times as much, trades at 120 per share. So that means the PE of 20. So far, the company doesn't earn that $6 per share, right? That hasn't happened yet. That's something in the future that they think will happen. But investors strongly believe it will. The stock market is a place where risk is taken based on assumptions about future value. That's the stock market. So if this company were to earn $6 per share, as analysts suspect that it might, then a price of 120 wouldn't be that bad. The idea is that in the future, the earnings and therefore the PE ratio will eventually catch up to that high valuation of $120 per share that Wall Street is assigning to this biotech firm. In fact, that would put the PE back at 20 if that were to actually happen and they earned that $6. The same concept applies to a tech company that just created some amazing software. And now, instead of estimating how much earnings the drug is going to bring in, analysts are instead estimating how much earnings that software sales are going to bring in. So these are the types of companies, by the way, that do tend to experience that fast growth. Tech companies, biotech companies that generally have the ability to explode their earnings if they create something. Back when the internet was a new thing, nobody had any idea how it would play out. Well, some people had a general idea and made a lot of money, but most people thought perhaps many companies would see their current earnings multiply many times over, but they didn't have any idea how much. So in many cases, just being quite overhyped, they were trading these technology stocks with PE ratios at 100 or 200, 300, 500 times earnings. Valuation kind of went out the window, and even experienced fund managers and analysts lose their head in a market mania. Now, market mania is defined by legendary investor Warren Buffett as a stock market where even the seasoned veterans stop thinking about reasonable valuation when they buy, and they only think about not missing the next huge price gain of winning stock. This is a good time for me to make a point about how different industry groups tend to have different levels of PE ratios. Like tech stocks tend to have high PE ratios because they're generally very profitable companies. Companies that are very profitable are companies that are more likely to experience faster growth over the years because they put that money back into their company. Faster growth prospects generally mean higher PE ratios. So even if two companies earn exactly the same dollar amount, then one company might have twice the valuation of another company because the growth has been much faster leading up to that point. So if you look at the profit margin of an internet company, it might be keeping $3 in profit for every $10 in sales that it generates. That's a 30% profit margin. They keep 3 out of every 10. Meanwhile, a retail clothing store might be keeping just $1.50 in profit for every $10 in sales that it generates, just half as much as that internet company that we just said, 15% profit margin. So that means that the internet company can likely grow at a faster rate, assuming that it reinvests that cash back into this fast-growing company that's able to multiply so fast. So let's look at a comparison between an internet company, you might have heard of it, little company called Google, actually technically it's called Alphabet now, and a retail clothing giant, Gap stores. So the PE ratio that we see here for Google is 32, and their profit margin is high, it's 29%. That's great for a company, especially that big. But with Gap stores, the PE ratio that we see here for Gap is 11, and their profit margin is down at just 3%. Low profit margin for now. Maybe they'll fix it. The Google is trading at 32 times earnings. They have a profit margin of 29%. That is, they keep $2.90 in profit for every $10 in sales. Gap Stores is trading at 11 times earnings, much lower. They have a profit margin of just 3%. That is, they keep 30 cents in profit for every $10 in sales. That's today. Those numbers evolve every quarter. And as the stock moves day in and day out, that means the PE ratio moves day in and day out. But generally speaking, companies that are expected to have a faster growth rate are usually going to have higher PE ratios. They're accepted. Let's talk about why. And I don't want you to get too caught up in this if you're a beginner, so don't worry. But to talk about why, let's start with the basic building blocks, and then we can work our way up to it. So imagine if you buy a company and you can never sell that company in theory. You would probably want to know how long it would be until you got your investment back and how much risk there is. The longer you wait, the bigger the risk. Now, this is all theoretical, not reality, mind you, but imagine that you can never sell it, but you buy a company and that company were to maintain its current earnings level the whole entire time you owned it, year in and year out, okay? So you pay $10 per share for this company, and you get to keep that $1 that it earns every single year. So it has a 10% profit margin. The stock remains at $10 a share every single year, but it pays you out its 10% in earnings, so $1 every single year. So at the end of year 2, you've collected $2. At the end of year 3, you've collected a total of $3, and so on and so forth. And at the end of the 10-year period, you get to recoup the $10 in total that you paid out. So this isn't reality, so we pretend inflation isn't a thing. But if that same company earned 20%, so it paid you $2 each year, you'd be paid back much faster, twice as fast. Again, the company's stock, it stays at 10 the whole time, but it pays you 20% that it earns, so $2 every single year. So in this case, with the more profitable company, bigger profit margin, that is in turn growing the company much, much faster, you'll recoup your initial investment in just 5 years, right? So we're good so far. Investors will assign a higher PE ratio to that company if that company is growing at a faster scale, especially if they think that's going to continue. Now let's add another layer, because this company isn't doing the smart thing if it can grow itself and it just lets the earnings sit there and do nothing, or if it pays it out. A growing company that's smart and more profitable is actually investing that profit back into itself, and that means it's compounding those returns. If you know the power of compounding, let's look at the law of compounding returns just in case you don't. If you start with a company's stock that's currently at $10 and earn 40%, you have $14 in value going into year 2, and then earns 40% again. That's 40% of 14. That's $19.60 in value going into year 3. Now we're compounding returns. Then in year 4, 40% on $19.60 is $27.40. Year 5, 40% on that is $38.40. Another 40% gets you to $53.70. Another 40% gets you to $75.20. Then $105. Then $100. Then $206.60. And in year 10, you've turned your initial $10 by compounding into $289.20 just by reinvesting that 40% back into your business, forgetting about taxes or anything else in reality. So the power of compounding is pretty cool, and it would take 20 years to get your $10 to $8,366, 24 grand in 30 years. So theoretically, if that company keeps earning that 40%, theoretically, that it's currently earning, in theory, after 10 years, it would bring you $289.20. So if you start with a different company stock, starts at $10 again, but it earns 15% instead of 40%, well then instead of ending up with $289 in value, you compound that 15%, you end up with $40.45 in value after 10 years, a lot less. So let's say both companies currently earn $131 million. I haven't told you exactly how much they had to sell to earn that 131 million, because I just pulled it out of thin air, 131 million, whatever. But imagine that all we know is both companies earned 131 million. If you only have that information alone, then you wouldn't know how to value the company, right? Are their earnings going up or down? Are they growing, or are they shrinking? Did they drop by a lot recently or gain a lot recently, right? What type of company is it? What industry? What's their profit margins? Well, if you know that one profit margin is 40% and the other profit margin is 15%, and they both are pretty consistent, that's the assumption, then we've just explained why you might want to pay $289 per share for one and $40.45 for the other. So in theory, you get paid back faster for the risk that you've taken. Investors are willing to pay higher multiples when there's more growth and or when there's less risk, right? Less time invested, less risk. So let's look at it the way that the stock market actually looks at it. You have all the building blocks now. So if you pay $289 for the 40% margin company, it would take you 10 years to get that money back. It would take 24 and a half years to get the money back from the 15% profit margin company. So they're willing to pay a higher multiple to earnings, PE, price to earnings ratio, when a company will likely grow faster. Okay? So I'm a technical trader at the end of the day. I think it doesn't really make sense to read too much into fundamentals as much as the technicals. To be clear, fundamental analysis studies earnings, PEs, sales, profit margins of the company, their strategy, and so on. Technical analysis studies price behavior, so investor behavior. Fundamental analysis is concerned with what should be happening if all the rules of logic were to be followed. Technical analysis is concerned with what is happening right now, even considering that people are acting irrationally, which is always the case on some level in the stock market. Besides, what is rational and irrational really becomes a matter of opinion most of the time, and that is the stock market. That's just how the stock market works. So we'll look at PE ratios and think about whether the market is overvalued or if an individual stock is overvalued. It makes sense to do it just to know what type of market we're in, because there's different types of markets, right? In overvalued markets, people are usually willing to buy into the hype and send stocks flying. And there's an old Wall Street adage that you should know: overbought doesn't mean over. Market tops generally take a long time to pan out before going down, many months and sometimes even years. So PE ratios are used by investors and analysts to determine the relative value of a company's shares in apples to apples comparison. So it can be used to compare a company to its own historical valuation, or to compare the company against the market in general, or to compare the company's valuation to the rest of its industry. So you could be looking at a technology stock and know that most technology is too broad. You could be looking at an internet company, an internet retailer, let's say that, and you look and see that they're trading with PE ratios on average around 25. And then you look at your internet retailer and you say, well, this one has a PE ratio of 60, more than twice as much as the average. Then you might say, well, in terms of PEs, which people take very seriously, this looks to be a little overvalued. And then you want to think about why. And maybe there's an announcement that they're going to launch something new in the future that they think is going to generate lots of earnings in the future. Now, I'm going to show you on your screen a list of PE ratios on an industry by industry basis. Okay, so there's trailing PE and forward PE. Now, trailing PE is the trailing 12 months PE ratio. So you would look at what the company's earned over the last 12 months, and then you multiply it by whatever. In this case of life insurance companies, the trailing PE on average for that industry is about 29. But if you multiply by what they expect to earn in the coming year, the coming 12 months, the forward PE is about 8. So obviously what they're saying here is that the E in PE, the earnings, are expected to go up by a lot. So if you're valuing these companies on average by what they've done in the past, you're going to have to multiply it by 29 to see where the average valuation is. But if you're multiplying by what they think they're going to earn in the future, which is a much bigger number, you can multiply it by just 7. They're trading at just 7 times. So when you're looking at trailing PE, it's important to understand that most of the time investors are looking at future PE or forward PE. You might hear somebody say, this company is trading at 13 times next year's earnings. And that is what's most important, because the stock market operates and is valued based on what people think are going to happen over the next 6 to 9 months in general. Sometimes some people say 6 to 12 months. Most of the time you'll see that the trailing PE is much, much higher than the future PE, because the forward PE is usually based on the assumption that the company or the industry in general is going to earn more, that E is going up. All right, so the divisor is going to be bigger. You're dividing by a larger number, and that's going to result in a lower multiple. But I want you to notice something here. I organize these in order of lowest forward PE up to the highest, and I'm going to scroll down here, and you can see that we have PEs. Once we get down here, you look at software or internet has a forward PE of 47 times earnings. That's what investors are accepting right now. Drugs, biotech. If you look at based on last year's earnings, these stocks are trading at about 480 times last year's earnings. But they expect, probably because of COVID and things like that, they expect to earn a lot more in the coming year. So they're trading at 75 times the coming year's earnings. Now, let's stop here for a second. Or let's go to healthcare. Healthcare, based on last year's earnings, 162 times. Based on next year's earnings, 77 times. So we're stopping on healthcare for a second. I want you to understand. Right now, we are in a market that in general is considered to be of a high valuation. Some would call it overvalued, but I don't really want to say overvalued too much here because it sounds like the market's going to go lower, but markets can stay overvalued for years. It's important to understand. But right now, Wall Street is saying that healthcare information and technology, so it's basically, it's almost like a tech stock, healthcare information and technology, healthcare IT, deserves a 77 PE ratio. But next year, the economy might fall apart. Maybe this industry doesn't do well for whatever reason. If circumstances were different, if people weren't as bullish, if people weren't feeling as positive on the market as they actually do right now, then Wall Street might be assigning healthcare IT companies a PE that's much lower. They might be assigning these PEs of 30 or 35. Well, let's just assume, right, the PE right here is 77, so let's assume it's a PE of 80, right? So with a PE of 80, XYZ stock may trade at $100 per share, okay? But with a PE, let's just say people aren't as bullish on this industry. So if the PE instead were 40, then XYZ stock, which again is earning the same amount of money, but people aren't as bullish on the future, people don't have as much of a positive outlook on the future, they might assign it a lower PE ratio. And all of these industries across the board might have lower PE ratios because people aren't very bullish on the stock market in general and on the economy in general. But if you assign the same exact company with the same exact earnings a PE of 40, then XYZ stock, instead of trading 100, would be trading at $50. So that's why it's important when you're looking at a company's PE ratio or an industry's PE ratio, see what the average is for that particular company or that particular industry, because it might be a fast-growing industry, might be a slow-growing industry, and it depends on the economy that you're in. It's a simple Google search to find stuff like this. All right, so let's get to the last part of this. Warren Buffett. Now, let's see. I wrote an article on Tuesday, and we're going to pull it up here on the screen. And it says, Warren Buffett calls this market manic. Here's why. And I'm going to pull this up because of the charts. Now, PE ratios, this is going to show you the last, this is going to go from 1990 up to today. And you can see the black line represents what the PE ratio currently is, which is about 40 times earnings. And this, it might look like that's kind of normal because you can also see the late 90s and 2000 where we got way up above the average. But look at the three lines, red, blue, and green. The three lines, red, blue, and green, you can see represent PE ratios of 20, 15, and 10, respectively. The red line is when the PE ratio is at 20. That's where the stock market would be at the time. So you can see back in the year 2000, you can see that red arrow. Let me just zoom in a bit here. See, back in 2000, you can see the red arrow, double arrow, and it shows the difference. Now, it points to the red line, and that red line is saying that if the S&P were trading with just a 20 PE ratio, the S&P would have been at 1,000 back then. But in fact, the S&P 500 was actually more at about 1,500 back then. Also, at about 15 times earnings, you can see the S&P would have been at about 800. But since the stock market was overly hyped, overly bullish, new tech boom, the PE ratio that was assigned was much, much higher. But I also want you to notice that we were above 20 for several years, even through the crash. Okay, so don't forget, when the earnings decline, the PE also goes up. So in times like the 2008 stock market crash, you'll notice that all three of those colorful lines went way down. And the stock market's valuation multiple did not go as far down. That's because earnings went down to almost nothing. Companies weren't earning anything. So the price to earnings was much, much higher. But one last thing I'm going to do here is I want to show you the view going back to 1925. You can see going back to 1925, the PE of the S&P 500 generally stayed between 10 and 20. When it was below 10, the market was said to be undervalued, and it was up near 20, anywhere near 20, it was said to be overvalued. So in the tech boom of the late 90s, really for the first time, you saw PEs get above 20, and then this chart only goes to about 26. Well, no, this chart only goes to 2019, January of 2019 to be exact. I just did this because I wanted you to see the last 100 years or so of PE ratios, and then we'll come back to what brings you up to date. Well, up to December 23rd, good enough on a 100-year chart. And you can see our current PE for the S&P is 39 times earnings right now, which is way, way off the charts. Higher than, I mean, in the year 2000, when nobody knew how to value anything anymore, nobody even cared, we were a little bit higher. But it's important to note how overvalued we are as a stock market as a whole. Again, you can always just Google what's the PE of the S&P and you'll find it. There's lots of different methods for valuing companies or valuing the stock market or valuing industries to determine if it's theoretically overvalued or undervalued. But again, most of the time the stock market is acting irrational, and whether it is rational or not is really a matter of opinion anyway. So I like to focus mostly on technicals, but it is also important to know what everybody else's opinion of the stock market is at the time. Don't forget, overbought doesn't mean over. And if you want more education like this, if you want more guidance like this, I'm doing it for free because I am an advocate to the individual investor. Subscribe to this channel. I'm going to be giving you a lot more really cool stuff for free. And I do own an investment research firm, which I've done since 2004. Since 1995, I've been a portfolio manager. I'm currently an institutional money manager right now. So you're getting the real deal. I've managed money for my entire firm. I've managed money for their biggest accounts. And back when I was basically a kid. So subscribe to this, or you can follow me anywhere on social media at Chris Rowe Trader. Share this with your friends if you think it can help, and comment, because I will answer your questions a lot of the time. So thanks a lot. This is Chris Rowe, True Market Insider, and have a great one. Trade safe.